Chinese and Asia-Pacific stocks jump, sometimes within minutes. China's share of global GDP and trade has expanded like crazy. A single China data beat can lift India's stock market by nearly 1% in one trading session. What happens next? This one macroeconomic data point from China actually impacts not just Chinese markets but also many emerging markets, specifically in Asia such as India. So in today's video, we'll get into the following. What macroeconomic data from China shakes the world? What happens when Chinese factory gives surprises? How this matters to Indian markets, smart positioning around production data days, and India's edge in the long term. Let's first talk about what macroeconomic data from China shakes the world. China is no longer just a manufacturing giant, it's the anchor for global industrial demand. It buys 60% of the world's aluminium, over half of the copper, and about 15% of all oil. So when we get fresh data showing Chinese factories are getting busier than expected, the world takes notice fast. In July 2025, the IMF dropped a paper that showed something fascinating. Among all the big Chinese economic data points like GDP, retail sales, CPI, exports, only one consistently moves global markets on the same day. That's industrial production. Why does this data matter so much? Because it's a direct measure of how busy China's factories are. It includes stuff like electronics, autos, machinery, steel, and chemicals. And when the output beats expectations, markets interpret it as a green light. Demand is back, growth is coming, risk on. But what happens when China's factories surprise to the upside? Let's say China's monthly industrial production is expected to grow by 4%, but the number comes in at 5.5%. That's a plus 1.5% surprise. What happens next? Chinese and Asia-Pacific stocks jump, sometimes within minutes. Industrial commodities, think copper, aluminium, oil, start rising. The VIX, a fear gauge for equities, drops, signaling calm in the market. Long-term government bond yields tick up slightly while short-term yields stay flat. Global equity indices, when they open later, tend to follow the upbeat mood. Even more impressive, when Chinese data releases happen on the same day as the data from other countries like UK or Japan, only the Chinese industrial production number shows a statistically significant market impact. This isn't just global growth optimism, it's China specific. And here's the kicker, this isn't a new trend, but it's an accelerating one. The IMF paper shows that the impact of China's industrial production surprises has grown by 4.5 basis points since 2016. That's huge. It means the markets are reacting more strongly today than they were a decade ago. Why? Because China's share of global GDP and trade has expanded like crazy. More exposure means more ripple effect. This means that as India builds deeper trade and financial ties globally, and as sectors like semiconductors, renewables, and defense manufacturing grow, we could become even more sensitive to China's industrial pulse. So why does this matter for India? In 21 of 27 markets studied, stock returns respond positively on industrial production surprise days, highlighting a coordinated global reaction. India isn't as tightly wired into China's economy as, say, South Korea or Taiwan, but we're still on the grid. On days when China's industrial production beats expectations, India's stock market shows a clear positive response. IMF data shows that India's returns on such days are roughly up by 0.09% compared to near zero on other macro surprise days. Let's translate that. A single China data beat can lift India's stock market by nearly 1% in one trading session. That's not small. That's the kind of move hedge funds and retail traders both try to catch. And the effect isn't just through stocks. Here's how the mood spills over. EM ETFs that include India get bought, lifting futures and index levels. Metals and oil prices rise, benefiting Indian producers but squeezing sectors like airlines, logistics, and paint companies. Volatility drops, meaning options become cheaper and more attractive for hedging or short-term bets. So even if China doesn't touch our favorite mid-cap stock directly, the broader market tone definitely does. If you're a bottom-up stock picker, you're probably thinking, okay, but what does it mean for the sectors I actually invest in? Let's break it down. Metals and mining, big winners. Higher Chinese factory activity means more demand for iron, steel, copper, aluminium. Oil and gas upstream also gain. Prices tend to firm up, improving margins for producers. Downstream oil consumers like aviation, paints, logistics, these suffer. Rising crude squeezes profit margins. Exporters to China, select chemical makers, capital goods, and machinery firms see tailwinds. Domestic consumer staples, less sensitive, often lag in these rallies. The bottom line is, on China's surprise days, Indian stocks with direct or indirect commodity exposure move faster and often further than the rest. Smart positioning around data days. Let's get tactical for a second. If you know that China's industrial production number is due, what can you do? Before the release, trim oil-sensitive downstreams like airlines or paint stocks. Load up on metals or upstream energy stocks if prices have dipped. Slightly overweight EM-focused index exposure versus developed markets. At release, if the number beats, lean into industrial cyclicals and exporters. Be cautious on consumer names with high input cost sensitivity. Volatility drops, consider adjusting or taking profits on hedges. After the move, don't overstay the trade. China's next policy action or global news can reverse gains. Remember, we're talking short-term sentiment shifts, not fundamental changes. Long-term, India still has the edge. Now let's not lose the plot. While China's short-term surprises move markets, India's long-term story is rock solid. Even if the index looks pricey today, specific sectors are on a tear. Urban construction and tourism can together rake in $900 billion by 2030. Auto components, semiconductors, cloud, cybersecurity, tech-adjacent winners are scaling up fast. Green energy, EVs, AI, aerospace, and even space tech, these aren't pipe dreams. These are billion-dollar revenue pools. McKinsey estimates that these sectors could add $2 trillion in annual revenue by 2030, boosting GDP by nearly 30% by 2040. That's structural growth, not driven by surprises, but by planning, innovation, and scale. So even if foreign investors are jittery and China's data shakes up the markets today, India's long-term runway is still wide open. If you care about your portfolio, don't just look at what's happening in Mumbai. Sometimes the action starts in Beijing. If you like this video, don't forget to drop in a like and subscribe to Wright Research for more such interesting updates.
Investment in securities market are subject to market risks. Read all the related documents carefully before investing.